Okay, so moving on to the next reading under portfolio management. We have done the overview of portfolio management. Now we're going to the basics of portfolio planning and construction. I remember when we talked about the 3 steps to portfolio management. Yeah, the 3 steps in the portfolio management process. We talked about portfolio planning, we talked about portfolio execution, and we talked about the planning step, the execution step, and the feedback step. So under the planning step, we're now trying to look at, give more detail, go into deeper into portfolio planning, which is what we do in the planning step. Yeah, we might not be able to finish this reading today, but I'll try as much as possible to cover as much as possible. Yeah. So like I said, when we did the portfolio management overview, that the most important step in the portfolio management process is to build is the portfolio planning. And the curriculum says it here to say, to build a suitable portfolio for a client, investment advisors should first seek to understand the client's investment goals, resources, circumstances, and constraints. Very, very important. You cannot overemphasize, sort of overemphasize this. It is too important. Yeah. Which is why I said the building essential foundation to your portfolio is planning. And the key to planning involves 2 things. Yeah. Everything which is said, understand your client's investment goals, resources, circumstances, and constraints, and develop your IPS. Those are the inputs into your IPS. So let's move into the next section. The next section talks about the investment policy statement, which is what I just mentioned now as the IPS. Yeah. So portfolio planning, just to give a bit of reading out of the curriculum. Yeah. Portfolio planning can be defined as a program developed in advance of constructing a portfolio that is expected to determine sorry, apologies, I got distracted a bit. Okay, so let's go back. So portfolio planning can be defined as a program developed in advance of constructing a portfolio that is expected to define the client's investment objectives. Yeah. The written document governing this process is the IPS. The IPS is sometimes complemented by a document outlining policies on responsible investing and the broadest umbrella term used to describe principles that typically address one or more environmental, social, and governance themes that an investor requires to be considered when evaluating whether whether to invest in a particular. So all this is, sorry to say, all this is story. Yeah. So basically, what they are saying here is portfolio planning is what you do before you go into construction. And the essence of portfolio planning is to determine your client's investment objectives. Yeah. And your investment objectives, which I'll call IO, cuts into 2 things: your risk objective and your return objective. Yeah. Then you also need to understand your client's investment constraints, meaning what are the things or factors that can impact us negatively from achieving these objectives. So these 2 things are the major information that goes into your IPS. So which is why the curriculum has said the IPS is the starting point of a portfolio management process. And I've said it severally, and I still say to my colleagues now that for every portfolio, you must have an IPS. The IPS is the document that governs the activities of that portfolio. If there is no IPS, then there's a problem. If there's no IPS, you have opened yourself to a very significant risk, which is what we call client risk. So you can see success can be defined as achieving these important investment goals using means that is comfortable, that he is comfortable with. So you need, the whole essence of portfolio management is to help your client achieve his investment goals. And in order for you to achieve investment goals, you must understand his objectives. Yeah. And you need to be able to document these objectives, because if you want to be successful, you need to be able to understand those objectives and see how you can achieve those objectives, which feed into his investment goals. So your IPS is a document, yeah, that is always signed by both the client and the client and the portfolio manager. Yeah, your IPS takes different forms, but the most important form of your IPS are your client's objectives, which is determining your client's risk tolerance or risk objective, and determining your client's return requirements or return objective. Yeah. Then, like I've mentioned, also in it, you have what we call the constraints. And what we've been able to do in the investment world is to categorize these constraints into 5 buckets, which are your liquidity constraints, your time horizon, your regulatory requirements, your tax status, and your unique needs. LLTCU. Regulatory, no, sorry, liquidity. No, there's, sorry, regulatory, legal and liquidity, legal and regulatory, tax, time horizon, unique circumstances or unique needs. So we've been able to bucket your constraints into these 5. But as we go along, those are things we are going to touch on today. Yeah. What are the major components of an IPS? These are the major components of an IPS. So, like the curriculum said, there's no standard, to be honest. Based on my experience, we've always been using an investment agreement, but we try as much as possible to have the investment objectives and the investment constraints in it. So basically, these are the most important aspect of your IPS, and they are consistent regardless of whichever form that you have. You must have these 2 things in your IPS. So a section that talks about investment objectives of the client, and the section that talks about what you've been able to identify as the client's constraints given these 5 categories. Yeah, very important. Any other thing is not necessarily important. So let's go into the onions of the day, which I probably feel this is what we would talk about significantly today, which is your IPS risk and return objectives. Yeah. Okay. So, or rather, let's talk about the IPS investment objectives that we can bucket into risk objectives and return objectives. Yeah. So, let's start with risk, because in the world that we're in, your risk drives your return. Yeah. Your risk is what we need to identify in order for us to determine what kind of return suits that level of risk that we see in you. Yeah. And anytime we talk about risk, we always like to look at it from the angle of risk tolerance. Yeah. So we need to understand the risk tolerance of the client. And when we say risk tolerance, we are saying what is the amount of risk that the client needs to take in order for him to meet his objectives. Yeah. What is the level of risk that the client needs to take, or the portfolio manager needs to take, in order to meet the client's investment objectives. Yeah. So your risk objectives are specifications for the portfolio risk that reflects the client's risk tolerance. So your risk objectives must align with what you have identified as the client's risk tolerance. So in this case, the risk tolerance is what is important. In order for us to draft a risk objective for you, we must understand your risk tolerance. So you have quantitative risk objectives and you have qualitative risk objectives. So your quantitative risk objectives can either be absolute, relative, or a combination of both. An example of an absolute risk objective would be a desire not to suffer any loss of capital, not to lose more than a certain percentage. So that's absolute. Absolute is I don't want to lose capital. I don't want my money to depreciate. I just want my capital to be preserved. That is an absolute risk objective. Or I tell you that given a span of 1 year, I don't want you to lose more than 5% of my capital. Don't lose more than 5%. That is another risk objective, absolute risk objective. But when we say relative risk objective, we are talking about things like comparing your risk of your portfolio to the risk of an identifiable benchmark. An easy identifiable benchmark, for instance, can be treasury bill rate. To say that, an identifiable risk of an for okay. So what they're saying here is for a relative risk, for risk relative to a benchmark, the measure could be no, that's not where it started from. So some clients may choose a relative risk objective, which relates risk relative to one or more benchmark perceived to represent appropriate risk standards. For example, investment in large cap UK equities could be benchmarked to an equity market index. We just talked about market index now. So meaning what we're saying here is whatever the risk of that benchmark is, I have been able to identify a market index as my benchmark. What is the risk of that market benchmark? My risk must not be more than the risk of that benchmark. Yeah. Some investments with cash-like characteristics, the benchmark will be an interest rate such as what? Treasury bill rate. For risk relative to a benchmark, the measure of risk is what? Tracking risk. Don't worry, you don't need to bother yourself with that. Yeah. So what these guys are saying is, if I'm looking at absolute, I'm giving you a percentage that you must not lose. I'm telling you that don't even lose. Yeah. While if I'm saying relative, I've been able to identify a benchmark, and I'm telling you that whatever the risk of that benchmark is, whatever the risk of the benchmark is, you need to match it, or you need to do better than it. Meaning, the risk of my portfolio must not be higher than the risk of that benchmark. Yeah. So that's risk objective. But like I said, your risk objective must flow from your risk tolerance. So let us now talk about risk tolerance. And like I said, your risk tolerance is the amount of risk that the portfolio manager or the investor needs to take in order for him to achieve his objective. Now, your risk tolerance is driven by two factors: ability to bear risk and willingness to take risk. Your willingness to take risk and your ability to bear risk are the two factors that drive your risk tolerance. Ability to take risk is, do you have the ability to take that risk? You are getting my point. Do you have all the resources to be able to take risk? While your willingness to take risk is personified. As an individual, are you a risk taker? As an individual, do you even your mental state allow you to think about risk? Are you the first person that the moment you hear risk, you cringe? So those are the things that we look at when we're talking about your risk tolerance. Yeah. Now, your risk tolerance, after we have looked at it from these two spectrums, can either be below average, average, or above average. Yeah. So, and if your willingness, if your ability, let's call that ability, your ability can either be above average, it can either be average or below average. While your willingness can also be above average, average, and below average. And whatever you score on these guys would flow into your risk tolerance, which can also be above average, average, and below average. We really don't talk about the averages, to be honest. We really don't talk about the averages. So we focus more on above average, below average, 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 below average, above average, below average. So if your ability to take risk is above average and your willingness to take risk is above average, so automatically your risk tolerance is above average. If your ability to take risk is below average and your willingness is below average, then automatically your risk tolerance is below average. Yeah. Yeah. Now, where we have some sort of conundrum is your ability to take risk is above average, meaning you have all the resources in this world to take risk, but your willingness to take risk is below average. Then there's a big problem. Yeah. We'll call that problem number one. Now, the second conundrum is you don't have all the resources to take risk, meaning that you have a below average ability, but your willingness to take risk is off the roof. Problem number two. And I'll give you instances. A man that suffers from problem number one is a rich man that has all the money in this world, but he doesn't want to take risk. Hence, he's investing in only fixed deposits and all his money are in savings. You have billions of naira, but everything is in the current account or is in a savings account or is in a fixed deposit in one bank. You don't want to take risk. Yeah. A man that suffers from problem two are the people that gamble. I have only 5,000 naira, but I am willing to take 4,000 naira out of that 5,000 naira to go and play a bet with the belief that the bet will crystallize and I'll become a rich man. That is a man that's suffering from problem two. Now, what does the curriculum say? How do we help this set of people? A man that suffers from problem one, I just need to educate him and ease him into his solution of his problem to say, bros, you can take risk. 1 billion naira. If you risk 100 million naira to take this risk, it doesn't affect you. Yeah? You're a billionaire, you have billions of naira. 10 million naira to or 50 million naira to take risk would not kill you. So don't you think you should take it? So those are the kind of conversations that we have with them. Yeah. While a man that is suffering with problem number two, you have to just tell him the fact. Baba, you will soon get broke and you will soon die. Or you will soon become broke and you don't have any money to spend at which you are going. You are spending almost 90% of the money that you have to be playing gamble. And you're eating on only 1,000. Then you come back to me the next day and tell me that I should come and borrow you. So you have to be straightforward with them because they have a psychological and mental issue. Yeah. So, but curriculum still says resolution must be done. But the easy route is, oh, there's a guy, he has a high ability and he has a high above average willingness. Automatically, he has above average willingness. So those are the things that, So let's now look at let's go in a bit into ability. So the ability to bear risk can be measured. We can measure it. It's a measurable factor. Yeah. So things like time horizon improve on your ability to take risk. I have 1 million naira. I want to invest it for 5 years. I can take risk with it. Yeah. My expected income, I am a big boy. I earn 10 million naira every year as salary. Why can't I take risk on 1 million naira? You are getting my point. That's expected income. Also boosts your ability to bear risk. Your level of wealth relative to liabilities. I have 10 billion naira sitting in an account and I have no liabilities tied to it. Why can't I take 100 million naira to take risk? Yeah. So those are the factors that sort of boosts. Age is another thing that boosts your ability to take risk. Yeah. Somebody that is 60 years old or 55 years old cannot take risk like someone that is compared to someone that is 25 years old. Yeah. So age also boosts your risk. Somebody that has 50 million naira at the age of 25 and somebody that has 50 million naira at the age of 55, the guy at the age of 25 can use 20 million naira to take risk. But somebody that has 55 million naira that is 55 years old and he has 50 million naira and you come to him to take risk of 20 million out of it, the guy will be a bit skeptical. He will say, man, what if this money goes at this age? How long will it take me to get 20 million naira back again? Bro, someone I cannot take risk. No vex. I beg you, let me buy treasury bill. Make I just chill. Yeah. So that is your ability to take. So there are things that we can use to identify if somebody has the ability. That's why we say ability to take risk is measurable. But for your willingness is very subjective. Your willingness is very personified. Your willingness has to do with your psychology. Your willingness has to do with your mind. Your willingness has to do with you as an individual. Has to do with the way you were brought up. A lot of things affect your willingness to take risk. You might probably have lost money at a point, or not even you, your dad might have lost money at a point in time, and that has affected your thinking about equities. I know a lot of people today now that don't invest in equities because they are still fixated on 2000 financial crisis of 2010. I know a lot of people till today, they are still thinking about the financial crisis of 2010. Every time you go to them and say, bros, how far more? You don't see the way Dangote sugar don't fly. The guy will say, oh, my bro, that equity market, waiting he show me for 2010. Because of that, I know they go back. But brother, that was 14 years ago. A lot of people have become billionaires in the last 5 to 6 years because of the equity market. But you are still fixated on 2020, 2020, 2010. So in order for us to be able to judge your willingness, most times we use a questionnaire, something like this. Yeah, this is just a short summarized one, but some people's questionnaire are more advanced than this. Yeah. So things like, investing is, just ask you questions. Investing is too difficult to understand. Do you agree or do you strongly agree? I'm more comfortable putting money in the bank than investing in stock market. If you agree, then it means that you don't like taking risk. If you don't agree, then it means like you like taking risk. When I think of the word risk, the term loss comes to mind. If you agree to this, then it means that you don't like taking risk. If you don't agree to this, then it means that you like taking risk. Making money is in bonds and stocks is based on luck. If you agree to this, then it means that you don't understand and you really are not a risk taker. But if you disagree to this, then it means that you can take risk. In terms of investing, safety is more important than returns. If you agree to this, then it means that you can't take risk. Then if you don't agree to this, then it means that you can take risk. So those are the factors that we look at all the time when we are looking at portfolio, trying to assess the willingness of an individual. Yeah. So the curriculum has put some methodology in how we sort of mark that. You can take that, you can look at that at your spare time. That really won't come out in your exam, but it's a good to know. Yeah. So they are both conflicts. This is where they talked about when you have a conflicting willingness and ability, how do you resolve it? And I've explained that to you guys already. So yeah, so this is an example that we can use to judge, so this example is a good one. I like to take my students through this. So Eric Gascon is an energy trader who works for a major financial oil company based in Paris. He's 30 years old and married with a son that is aged 5. Gascon has decided that it is time to review his financial situation and consult a financial advisor who notes the following aspects of Gascon's situation. Gascon's annual salary is 250,000 euros. Is more than Gascon's annual salary of 250,000 euros is more than sufficient to cover his family outgoings. Gascon owns his apartment outright and has 1 million euros of savings. Gascon perceives that his job is reasonably secure. Gascon has a good knowledge of financial matters and is confident that equity markets will deliver positive returns over the long term. In his risk tolerance questionnaire, Gascon strongly disagrees with the statement that making money in stocks and bonds is based on luck. And in terms of investing, safety is more important than returns. He disagrees in those two. Gascon expects that most of his savings will be used to fund his retirement, which he hopes to start at the age of 50. By the way, he's 30 years old. So he has 20 years to work. And already life is already good. It's all right. Based only on the information given, which of the following statements is accurate? A. Gascon has a low ability to take risk, but a high willingness to take risk. B. Gascon has a high ability to take risk, but a low willingness to take risk. C. Gascon has a high ability to take risk and a high willingness to take risk. What is the answer, in your own opinion, is Gascon? Anybody wants to try? Anybody wants to try?
I think it's C.
Hello? You think
I
it's
think it's
C?
C.
Why? Why? Go ahead.
Because
Why?
he's doing well financially, so he sort of has the high ability to take risk. Then his knowledge about financial matters and disagreeing with the fact that money in stocks is and bonds are based on luck shows his high willingness to take risk.
Fantastic. Thank you very much. That's a very fantastic response. I like that. The answer is C. Now, let's look at another individual who is Gascon's brother. So, Marie Gascon is pleased with the services provided by a financial advisor, and she suggests to her brother, Jacques, that he should also consult the advisor. Jacques thinks it's a good idea. Jacques is a self-employed computer consultant, also based in Paris. Sorry, Jacques, a self-employed computer consultant, also based in Paris, is 40 years old and divorced with 4 children, aged between 12 and 16. The financial advisor notes the following aspects of Jacques' situation. Jacques consultancy agency, consultancy earning average 40,000 euros per year per annum, but are quite volatile. Jacques is required to pay 10,000 euros per year to his ex-wife and children. Jacques has a mortgage on his apartment of 100,000 euros and 10,000 euros of savings. Jacques has a good knowledge of financial matters and expects that equity markets will deliver higher returns, very high returns over the long term. In the risk tolerance questionnaire, Jacques strongly disagrees with the statement, "I am more comfortable putting money in the bank account than in the stock market. And when I think of the word risk, the term loss comes to mind." Jacques expects the most of his savings will be required to support his children at university. Based only on the information given, which statement is correct? A. Jacques has a low ability to take risk, but a high willingness to take risk. B. Jacques has a high ability to take risk, but a low willingness to take risk. C. Jacques has a high ability to take risk and a high willingness to take risk. What are your thoughts? Anybody in this class?
I think it's
Hello?
A.
Okay, why? Why do you think it's A?
Financially, I think he's not in a good position, given what he has to pay from his mega earnings of 40,000.
Okay,
He still has a mortgage
okay,
on his apartment that he's also paying. He also has a
okay,
very low savings of 10,000 euros as at today.
okay,
Right.
okay.
However, in terms of willingness, in terms of his
To take
willingness,
risk.
I think he has a very high willingness in terms of since he understands that is that generating, what did he say? He's comfortable, right? Putting money in the stock market rather than in the bank. And he also thinks that the world risk is against the world risk being a loss. So that means if he has the money, be able to willingly invest. So I think the answer is A.
Fantastic. Thank you very much. You are very correct. And the answer is A. And you gave 100% explanation to that. Thank you very much. Now, that is all on risk tolerance. Like I said, your risk objective is driven by your risk tolerance. And if you can identify the individual or the investor's risk tolerance, you can comfortably determine what the risk objective is. So let us move to the other investment objective, which is return. Yeah, a client's return objective can be stated in a number of ways. Similar to risk objective, we have absolute return objective and relative return objective. Absolute return objective is to tell you that I want you to meet or achieve a certain return. Yeah. While relative is same way, comparing it to a benchmark and telling you that your return must be higher than the return of that benchmark. Yeah. However, when we talk about return, we focus a lot on a term called required return. So there's something called desired return. Desired return is different from required return. Now, required return is the return that the client needs to earn in order for that objective or that investment goal to be achieved. Okay, so required return is the amount that the investor needs to earn to meet that particular future goal, or the return that the investor needs to earn on that investment to achieve that particular investment goal. Your return objective needs to be very realistic. Yeah, and you need to consider market conditions and also the client's risk tolerance. So your return objective must align and must be consistent with your client's return risk objectives. So a typical instance is somebody that cannot take risk cannot be demanding for high returns, and somebody that can take risk should not be giving low returns. So there must be some consistency and alignment amongst those things. And you must also consider your market condition. So somebody comes to you and tells you he wants a 21% return, but there's nothing that is delivering 21% return. So how do I want to give you 21% return? Yeah. So we always speak about the required return when we talk about return objectives, and we put conditions to it that it must be consistent to the risk, and you must give consideration to your market environment. It must, which is what I just said here. I just said this now. It must be consistent with the client's risk objective. Very important. Very. This one is even too important than market conditions. But like I said here, when a client has unrealistic return expectations, the manager or advisor will need to counsel her about what is achievable in the current market environment and within the client's risk tolerance. So very important. You need to tell her you cannot get this. So there's nothing that will give us 21%. You know, and also we need to tell them the fact that since your risk tolerance is low, it will be hard though, you know, so for us to be chasing risk, because if money to go, there will be problem. So this is a typical example again that we can look at. So having assessed our risk tolerance, Marie Gaston now begins to discuss our retirement income needs with the financial advisor. She wishes to retire at age 50, which is 20 years from now. Her salary meets current and expected future expenditure requirements, but she does not expect to be able to make any additional pension contributions to her fund. Gaston sets aside 100,000 euros of her savings as an emergency fund to be held in cash. The remaining 900,000 euros is invested for her retirement. So that means you have 900,000 naira that you need to invest for 20 years. Yeah. Gaston estimates that a before tax amount of 2 million euros in today's money will be sufficient to fund our retirement income needs. The financial advisor expects inflation to be 2% per year over the next 20 years. Pension fund contributions and pension fund returns in France are exempt from tax, but the pension fund distributions are taxable upon retirement. Yeah, upon retirement. So, question number 1, which of the following is closest to the amount of money Gascon will have to accumulate in nominal terms by a retirement date to meet our retirement income objectives? So, which of this, yeah? So, which of this is closest to the amount of money that will have to be accumulated in nominal terms? Yeah. So, the answer to that is 3 million naira. And why do we say so? So, what we're saying is, if in today's terms, she says she needs 200 million naira and inflation is 2% every year, then it means that this 2 million naira needs to grow at 2% every year for the next 20 years, which is what they've done here as calculation. So the answer to that is 2.97 million euros, which is equivalent to 3 million euros. I hope you guys get that. Now, number 2 is, which of the following is closest to the annual rate of return that Gascon must earn on a pension portfolio to meet a retirement income objective? Now, what are they saying there? She has this amount of money now, but what she needs after 20 years is this amount. So at what rate would $900,000 grow to $2.97 million after 20 years? And the answer to that is 6.2. Apologies, I've done this example before. That's how I know. Because somebody will say, how did you know? That's how I know. So you see what I did here? So this is the 2.9 million. This is the 900,000. Then you solve for X. Yeah, you solve for X. So yeah, so that's that. So what they're trying to tell you is to calculate the return. So this is the return requirement for Gascon right now. If she invests her money in an amount that is less than this, then she will never meet that objective. So on an average, what she needs to be investing is nothing less than 6.2 million naira. 6.2% per annum is what she has to be investing now on an annual basis. Okay, now we have talked about return objectives. We have talked about risk objectives. We have told you that your return objectives must be consistent with your risk objectives. We have told you that your risk objectives is driven by your risk tolerance, and your risk tolerance is driven by your ability and your willingness to take risk. Yeah, and we've told you that your return must be consistent with your risk objective. And we said when we talk about return objective, we should focus more on your return requirements, meaning the return that you need to earn in order for you to meet that future investment goal. Yeah. So let's move on now to IPS constraints or investment constraints. And when we say investment constraints, we are saying that what are those factors which we have already identified, and how do these factors affect your ability to achieve your investment objectives? And the first one is liquidity requirements. Now, when we say liquidity requirements, we mean how often does the client need money from that fund? Or are there going to be any instances? So if we use Gascoin as an example now, so let's use Gascoin. So we've been able to say Gascoin has an above average risk tolerance. So it has an above average risk tolerance. So that means you can take risk. And I'll be able to say that the return requirement for her is 6.2. Yeah. And we're now saying that she wants us to invest 900,000 euros for the next 20 years. The first question I'm going to ask Gascoin is, within the next 20 years, would you need cash? would you need money from this $900,000? Would there be any circumstance that might happen in the future, seem unplanned or unplanned, likely or possible to happen, that would make you come to us and request for money out of this $900,000? Because the moment you do it, that means that 2.9 million euros that we want to achieve for you would not be achieved. That is our liquidity requirement. I need to know if there's any possibility of a cash withdrawal, significant cash withdrawal from the $900,000 from the investment portfolio. Now, your liquidity requirements can be planned and it can also be unplanned. Now, what do I mean by it can be planned and it can also be unplanned? So the Gascoigne can say, you know what, my child is 5 years old, and for a funny reason, I feel that he might want to do masters at the age of 21, which is 16 years from now. So in 16 years from now, I might come for 100,000 euros. Yeah, that's a planned liquidity event. Or she might say, you know what, I have a house now, and by the time I retire at the age of, say, I retire by probably at the age of 40, which is 10 years from now, I can start planning for retirement. Yeah, so what will I do? I can sell the house I have now and probably move to a retirement home, or rather move to a more robust home that suits how I want to live my life in retirement. So at that point in time, I might probably want maybe 50,000 euros. That is another planned liquidity requirement. Yeah. However, the one we don't like is the unplanned. So imagine today, Gascon tells us that there's no possibility that she would ever come for money in the next 20 years. But behold, come 5 years, a medical situation arise, and she needs to what? Support. She needs a huge, the cost of the cost of the medical situation is very high. So as a result, she can come to you and tell you, bros, please, I'm sorry, I need $50,000 from the money that I gave you. It's not my fault. I did not plan it, but that's what we have seen. There's a need for me to what? To use that money for my medicals. You cannot say, because we did not plan it at the beginning, you did not say, you're going to come for money, I won't give you. No, you have to give her. Because if you don't give her, she's going to take you to court and sue you. So, as a result of that, we always like to understand the liquidity requirement of our clients. Very, 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 very important. It is too important. And we always pray. Sorry, did I use the word pray? We always pray that we don't have unplanned liquidity requirements, but that's what liquidity requirement is all about. Now, the next is what? Time horizon, the length of time that you want to invest in. If you look at Gascon's situation now, Gascon has 20 years. 20 years is sufficient time horizon, very sufficient time horizon. And as a result of that, I don't think that is going to deter or affect our ability to achieve the investment objective. Yeah, but we like to understand our clients' time horizon, because the time horizon impacts our ability to take risk. So if your client horizon is short, it determines the kind of investment you can make, the kind of risk you can take. If the time horizon is long, it also determines the kind of investment you can take. So time horizon has a significant impact on, you can see, time horizon of the investor will affect the nature of investments used in the portfolio. Yeah, because if your investment is short, I cannot invest in illiquid investment. I cannot make illiquid investment or take risky investment. So time horizon is like the most important constraints that we look out for, which we always know at the point of having our conversation with the clients. Like we've spoken to Gascoigne now. Gascoigne has already told us, oh, this money is my retirement. I'm 30 years old. I'm retiring after 20 years. Yeah. So we know already we can take risk with this man's money. Yeah. Okay. Taxes, tax concerns. I always say this a lot, and I like to say this jokingly. Yeah. In a country like Nigeria, when we invest, we are not particularly focused on taxes. Yeah. But in other climes and the well-developed countries, tax, you cannot run away from it. Yeah, you cannot evade tax. So they are very, very, very concerned. They are very, very tax conscious. Very, very tax conscious. So at every point in time, they want to ensure that whatever you're investing in will not lead to what? Them paying too much money to the government as taxes. So you need to understand your client's tax concerns, tax peculiarity, tax bracket, and all that. Yeah. Okay. Now, the next is legal and regulatory factors. Yeah. This is where you need to understand the regulation, how the law affects your clients, how you have to, for the purpose of that client, comply to certain laws that are applicable to that client. Yeah. So most times for individuals, you really don't see this being something that jumps at you. But for institutions, it jumps at you. For instance, now, if a pension fund is my client, I need to go and understand all the pension laws, because nobody will want a situation whereby I do and I make a particular investment and the pension regulators come and tell me that this investment I have made is contravenes what? Their law. And as a result of that, I have to pay a fine. So all those things are things that you need to consider and see how those laws of that particular that are applicable or the client is exposed to sort of affects your ability to invest. Yeah. Now, lastly, is not last one. Yeah. This is the last one. The last one is what? Unique circumstances. There are some clients that have unique needs. And I like to most times, I try to most times use Sharia compliant investors as an example. So as a Muslim and a practicing Muslim, I focus only on Sharia compliance investing. And for me, that means that whoever is managing my portfolio must consider my faith and my moral values. So e.g., they cannot buy stocks of gambling companies, pornography, tobacco, alcohol, all those things are eliminated from my portfolio. Yeah. Also, banks, because I don't like companies that deal in interest rates. So those are the things that we talk about in terms of special needs. Another instance I can give you is a guy can tell you that because he's the managing director in an oil and gas company, he wants to make investments that are not oil and gas companies. So I need to make investments that are outside the oil and gas. That's for me diversifying my life. All my life has been in oil and gas, but now I want to have exposure to other aspects of the market. So that is another unique circumstance, and these things happen day in and day out. Yeah. Another one is ESG. You must have heard of ESG, economic, social and governance investing, where some companies do some sort of screen to be able to identify the kind of companies that are ESG compliant. Yeah. So that's another unique circumstance. Okay, so that's that on our constraints. Yeah, so we've talked about investment objectives, we've talked about investment constraints. And this is what I always tell people: as easy as it is, you look at it as RRLLCTU. Risk objectives, return objectives, liquidity requirements, legal and regulatory, tax, time horizon, unique circumstances. If you have this, you can never forget, what's that word? You can never forget investment objective and constraints. Now, Client information gathering, like I mentioned, it is very important you gather all the information that you need about your clients. It is just too important. You need to know your clients, not necessarily that you'll be following up and down, no, but at least you need to know the most important of the important. And a typical example is the health. Not only the health of the client, the health of the client's family. Those are things that can lead to unexpected liquidity needs. Yeah, it's good for you to know what the wife is doing, what school the children are in, what kind of job does he do? Does he have multiple sources of income? So you need to gather as much information as as possible. It's just too important. Just too important. Yeah. Okay, so just too important. And that's what this is all about. Yeah, understanding and gathering all the information, because that's everything you do in the planning stage. Yeah, everything you do in the planning step or in portfolio planning is gather all the information about the clients, draft up your RR, determine what your LLTTU is, draft your IPS, share it with your clients, let your clients and yourself sign it, and you're done with portfolio planning. That's everything about portfolio planning. Now, let us move to, are there any questions? Any questions? Any questions? Any questions?
Yeah,
from any?
sorry, I just want to ask this. Does this apply in the same way when you are dealing with a corporate body?
Yeah,
Oh,
yeah. Same thing, regardless of the kind of clients you have. As long as it is an investment client, you have to do this. You have. It's even easier because you can give the corporate body. The corporate body are a bit more exposed. Yeah. So you can give them even a questionnaire that will help them that they will help you solve this by themselves. You don't have to disturb yourself. Is that fine?
yeah, that's good.
Okay. Okay, so let's move to the second part of the reading. So the second part of the reading is portfolio construction and capital market expectation. So for this reading, I'm going to go a bit technical. And I was sitting down here and I was asking myself, should I talk about this now? Or I should talk about this? Let's hold this and sort of come back to this. I really don't understand why the curriculum have sort of structured this now this way. But what I would do is, I think, let us end the class here and I'll explain. So there's a reading that I need to touch on before I come to this, and that reading will make this remaining section of this reading very easy for us to understand. So that takes away all the technicalities and all the rigor, or teaches us all the technicalities and all the rigor let me use technicalities, yeah? So you don't teach us all the technicalities that we'll talk about from this aspect of this reading going forward. And that is your risk and return 1 and 2. So by the time we're done with risk and return 1 and 2, we will come back to this reading. So I'm going to pen it down now and assume that I haven't done this. Yeah, so I'll come back to you on this. So I think we can comfortably end the class here and revisit this after we're done with risk and return 1 and 2. I hope that is fine.